G'day guys, it's Tim here. It's been a couple of weeks since we've done one of our market updates and we've seen a number of significant things happen in the finance and lending environment. So today we wanted to talk about interest rates and people's mortgages and how things are looking and moving forward, all right? So firstly, we get a lot of questions from people about how interest rates are looking, particularly with the changes we saw earlier in the year. We saw APRA, which is the regulation authority around lenders, put in a restriction that required that no more than 30% of new lending was done to interest-only loans. This is on top of the changes that APRA made to a lot of the lenders last year, requiring them to hold more capital for the amount of loans that they were giving out. Now, one of the biggest concerns and one of the things that we see a lot in the news nowadays is that currently Australia has the highest household levels of debt that we ever had. And we do see a lot of interesting, narratives around this. You know, some people think that this is what's leading us towards some form of housing crash. In reality, and certainly from my perspective, the levels of household debt that we have are in no way, shape or form anything to be worried about, considering that the asset values that we have are also the highest that we've ever had. Primarily what we're also seeing is that the level of Australians which are experiencing mortgage stress are lowest that we've seen in a number of years. There was a recent survey done by Mortgage Choice which actually found that the percentage of income that people are having to use to pay their mortgage is the lowest that we've actually seen in 5 years. So mortgage stress is certainly not something that's impacting a lot of people. And once again, the findings of this study was also that the reason why sometimes people are falling behind in their payments is actually more due to changes in their personal circumstances, like possibly a relationship breakdown or losing their job. Now, employment, obviously that's something that we need to keep our attention on as well. 6th consecutive month we've seen more job advertisements each and every month, which leads us into certainly as we start to head into the second phase of the global land cycle. And for those of us, or for those of you out there that have been, watching a lot of these Facebook Lives, or of course certainly for those of you that are clients, when we talk about the global land cycle, you'll specifically know what I mean. If you don't know what I mean, then that's a really great reason to maybe get along to one of our workshops. There's been very specific cycles that have operated for the past 250 years. And understanding these cycles and where we're at these cycles can really give you a lot of very valuable information to know about whether, it's something that you should be considering doing in terms of investing, whether you should be expanding your investments, whether you should be consolidating your investments. Certainly probably one of the most valuable things that I've learned, and it's one of the things that I've continually studied through the economists that I've worked under for the past number of years. Okay, but anyway, let's get back to mortgages and interest rates. So how are we seeing things move? So, like I said, APRA brought in the restrictions about new lending had to be under 30% for lenders for their interest-only loans. Now, this obviously caused a great deal of concern for some of the lenders out there. Some of them were certainly operating over this threshold. Now, one of the ways that they moved to restrict this form of lending was to significantly move the cost of interest rates for interest-only loans up. Obviously, if the interest-only loans are more expensive, then people will look at doing things like principal and interest. Okay, so what we've actually seen is that probably many of those lenders overreacted to what they were holding in their portfolios. They probably put their interest rates too up. We've seen significant decreases in the level of interest-only loans. And what we're actually now seeing is we're seeing a number of lenders, particularly some of the big lenders out there, are starting to lower their interest-only variable rates, once again trying to get a bigger piece of the market share. On the flip side, for those people who were looking at paying things like principal interest, or in comparison to the investor lending that we've been talking about for owner-occupiers, because of where we're at in this global economic cycle, global land cycle, we're at the point in the cycle where we start to see lending and credit availability increase. So the restrictions to loosen and the availability and credit to become more and more available, which then pushes up into the second phase of the cycle. Hence, what banks have been doing is they've been being very competitive when it comes to their principal and interest loans or their owner-occupier loans. Okay, so that's something that we've seen a lot of. In fact, many of the things that we've been doing for our clients over the past month or two is that some people are able to actually be on principal and interest and have their monthly payment be lower than what it would be on an interest-only loan. Or certainly in the case that that's not the case, maybe not considerably much higher, and they've got the added benefit of obviously paying down their debt as well. What we're also starting to see now as well is we're starting to see fixed interest rates come down, okay? Now, this is always a really good indicator about where the banks think the interest rate cycle is heading. Currently, what the markets are really pricing in is they're pricing in only a 50% probability or 50% chance that interest rates are going to rise in May 2018. So it gives us a really unique period coming up where people are able to start getting access to more available credit while still being in the lower interest rate environment. Now, a lot of APRA's moves were designed to temper the growth that was happening in the Sydney market. We've certainly seen those results happen. We've seen things significantly slow down in Sydney. And of course, while APRA was trying to temper the growth in Sydney, where other markets were starting to try or wanting to try and pick up, we weren't really able to get a lot of traction there, particularly markets like Perth as an example. Okay, so now that we've got interest rates, still being stable and maybe only seeing some minor increases possibly over the next 12 to 18 months and more available credit, i.e. more competitive rates into things like interest-only loans and investor lending. It is a pretty unique time and a great opportunity for people that are looking to invest to really start getting into the market. So pretty much that's all I wanted to touch on today, just with regards to what's happening out there with the lenders, what's happening with interest rates. If you are someone that does have a mortgage, maybe you haven't had done a bit of a health check on your mortgage, it would be a great idea to get in contact with the team at Infinite Finance here to see what we can do. I mean, I'm getting reports every day for, being able to save, 5 digits for our clients over the coming 2, 3, and 5 years in terms of things like interest rates and packages. So if you want to save some money, get in contact with Infinite Finance. Apart from that, guys, you want to know more about the Global Land Cycle, get along to one of our events. I hope that's giving you some valuable information. We'll look forward to speaking to you soon. Okay, thanks, guys. Good night.